I'm Eric Schurenberg, editor-in-chief of CBS MoneyWatch.com. We're taping here from the Morningstar Conference in Chicago, and I'm being joined by Ross Levin, president of Accredited Investors in Minneapolis, and one of the pillars of the financial planning industry. Ross, thanks for joining us.
Thank you, Eric.
This is a tough time for investors. There's so much to worry about. There's North Africa, there's inflation threats, there's deficits, there's a lot of poor mouthing coming out of Washington. What are you telling clients to do about the scary headlines these days with their money?
You can't ignore the scary headlines because they're real and they affect you every day when you read them. But there's a couple things that I think you should be thinking about. First of all, if you need to spend any money, that should not be invested. So what we like to do for our clients who are living off their portfolios, we take 3 years worth of income and we stash it. And there's places you can stash it, online savings accounts, short-term corporate bond funds, things that are relatively safe. But otherwise, if you're not going to spend the money in 3 years, and most likely if you're continuing to buy over the next several months or the next several years, you want to make sure your allocation is set up appropriately and that you're allocating your dollars where you want to go. Because remember, the best thing that can happen if you're a net buyer of equities over the next 10 or 15 years is for the markets to stay soft.
For the next 10 or 15 years?
Sure.
We've already seen that.
Yeah. So
you want them to firm up eventually, don't you?
Eventually. But you know what's interesting about that? People talk about the lost decade from 2000 to 2010. It was a lost decade for the S&P. It was a lost decade for the NASDAQ. It wasn't a lost decade for value stocks. It was not a lost decade for international stocks. It wasn't a lost decade for bonds. So that's why you diversify, because you're going to have certain areas that will do okay, and you want to make sure that you don't overbet. You don't overbet to cash, and you don't overbet to equities.
Well, one of the asset categories that did pretty well during the crash was Treasury bonds.
Yes.
But now Treasury bonds are a very different story. We heard a lot about that from Bill Gross yesterday.
Yeah.
What is the safe anchor in a portfolio if it's not bonds? You put aside your 3 years of cash. What is the safe anchor in the rest of your portfolio?
I think if you're going to look at bonds, you still need to have some bonds, but from a bond side, what we like looking at are a bond fund, for example, like a Luma Sales, which is currency and credit. We also like these online savings accounts because you can get, for example, one of them offers 2.3% on a 5-year CD. You can break that lock for only a 2-month interest penalty. So you're going to get 2%, 2.25%, even if you only hold the investment for 10 months or so.
What bank offers that?
allybank.com, and it's FDIC insured. So that's the kind of thing that you can look for because you're trying to find opportunity for when you can put that bond money to work. The hard part, Eric, is that people who are living off their portfolios, these low interest rates have just killed them. They might have thought they avoided the stock market risk, but if you bought a 10-year treasury in 2000 and you're looking to reinvest today, you might have had a 60% loss of spending power.
Mm-hmm. What's the hardest thing to get people to do, to get your clients to do in a market like this? And by extrapolation, what's the hardest thing to get for a self-starter investor to do himself?
So I think the hardest thing are those people who got really scared in 2008 and 2009, left the market, have seen the market go up 100% since they're gone, and are saying, what do we do now? How do we get back in? And what I don't think they should do is just dump their money in the market. I think what they should do is set targets for themselves. So they should either do a monthly target, so every month for the next 12 or 18 months they're going to put money to work, or a price target. So every time the S&P falls 3%, they're going to put money to work. And by doing that, what you've done is you've taken the risk out of the market never falling and never getting invested, or putting all your money in tomorrow and the market falls the next day. So I think you want to have a strategy both ways.
It's kind of a psychological trick. If the market falls 3%, you put money in. You can't decide. You've made that rule. You have to stick to it.
Right. And the question is, will you stick to it?
A lot of investors have lost faith. Let's face it. There was a study recently that Prudential did that said 44% of investors would never buy stocks again, or so they said. And 60% believe that some of the principles that we've just talked about here, asset allocation, diversification, don't really apply anymore. What do you say to people like that?
Well, first of all, diversification works. It worked in 2008. It didn't work well, but if you think about it, international stocks were down way more, for example, than large cap US stocks. So, I mean, there's different ways that diversification works. It doesn't mean you're going to make money in every kind of environment. The second thing is that you've got a bunch of different risks that you need to accept in your life. One risk is the risk of volatility. I put money in the stock market and it goes up and down. But another, I think, more important risk for most people with a long time horizon is purchasing power risk. And inflation. And you are not going to beat inflation over the long term by avoiding stocks. And where are you going to put your money today? In bonds that are at historically low yields relative to stocks? I don't know. I think that that's a really bad bet.
Great.
So,
Ross, thank you very
Eric.
much.
Appreciate it.
And thanks for watching.